So turning to our attention to protection and protection products, which for many is their most important financial need, protection against the unforeseen circumstances that ultimately could cause financial hardship. And I think it's fair to say that the protection that we require and the protection that's available from, say, the state changes as we go through our lives and are very unique to everyone's individual circumstances. The role of the financial advisor when it comes to protection is to consider every single aspect of this and obviously ensure that as closely as possible any needs are addressed. There's lots of products out there, there's lots of product providers to choose from, and whether you are an independent financial advisor or an appointed representative of a particular firm, you will obviously have a range of products and services that you can provide to clients to meet their protection needs. So shown on the carousel here, we can see a certain number of protection influences, things that will actually have a bearing on our needs for protection over the years. And things such as our age, generally speaking, insurance is cheaper the younger we are. Our health, obviously the better health we're in, typically insurance is cheaper. The number of dependents that we have, and dependents we mean categories of younger children perhaps, and also elderly relatives. Our income and our expenditure, of course, can have an impact on the need to provide some kind of protection for that. The liabilities we have, generally speaking, most people would have some kind of protection in place to repay debt. The existing cover we have from either our employers perhaps or existing plans, and of course the level of state supports, and we always need to consider this and whether or not the individual would like to rely upon that. And state support, of course, can be either dependent on certain circumstances, means testing, certain income and capital requirements, or alternatively dependent on NIC records, national insurance contributions, etc. So all of these need to be discussed with the client whenever you're dealing with protection needs. So looking at those in more detail then, and we'll take some of these in turn. So looking at age, obviously protection needs change throughout our life, which is somewhat of an idealistic approach to it in many respects. In our teens to our mid-20s, as we start into our careers often, maybe we're taking on debts, we might need some kind of protection to protect that debt. But generally speaking, responsibilities are relatively low, and given the fact that that's the case, the protection needs are quite often not seen as a priority. Then we go through our earlier life, our mid-20s to our mid-40s, where we essentially start a family, we take on more debt, buy our homes. In this phase, really, the protection comes to its own, and this is where there's the heightened need for protection products normally is there. As we go into our mid-40s to our mid-50s, then perhaps our focus might turn towards education costs for the children, go to university or private education, and even turning our attention towards our retirement and the retirement plans that we need to actually put in place to allow that to be comfortable. From mid-50s to retirement, the focus generally is on retirement, later life planning, estate planning. And there's an evolution, is what we're saying here, of your protection needs as you age. And generally speaking, the more older that you become, the more you need, and in generally speaking, the more you'll need those regular reviews. Health is another important factor when considering the protection needs of individuals. And it's important to understand that both short-term incapacity to work and long-term serious illnesses can put immense strain on the finances of even the most prepared individuals and families. You need to consider the family history of individuals whenever we consider the impact of protection and protection products as well, as this is often an indicator of potential problems that may arise later in life. Of course, having dependents and the number of dependents that you have has an impact essentially on the protection needs of families and individuals. So whether dependents are young children, their educational costs, or old for long-term care costs, you should always consider the impact of these particular life instances of ill health and the impact that would have. You must consider the dependency age of children when planning for their protection needs, and making sure that any protection has a contingency built in to ensure that it extends beyond the expected age of 18 or 21 that traditionally we would see as dependency age. This, of course, needs to cover things like aspects of university cover, etc. So it's always important to consider the number of dependents and the dependents' needs when providing financial support for them through protection policies. Of course, an individual's employment status and or self-employment status, as the case may be, is a crucial part of considering the ongoing income that somebody would have, and the length of time that they're paid if they're incapacitated, or alternatively the length of time that they could provide for themselves in the event of incapacity, is a crucial part of financial planning. Replacement income is one of those insurances that, generally speaking, people tend to bypass, and actually can have as big an impact as any long-term illness or death on anybody's individual circumstances. We should all be encouraged to build up contingency reserves. The general budgetary planning of having money set aside for a rainy day has never been more important than when considering this particular area of financial planning. And for some people, particularly those that are self-employed, it may well be seen that income protection is actually as important, if not more important, than some of the more family protection environments. Those individuals that have a degree of liabilities are likely to require debt protection for these to ensure that they can meet their obligations both in the short and long term in the event of ill health or death or serious illness. So essentially, debt protection is likely to be taken, and you can take policies that are specific for meeting the actual needs of liabilities, such as payment protection insurances. Should at least cover the essential expenditure and ongoing liability, and potentially any ongoing taxes that are covered by this will also need to be considered when they're providing some kind of protection. The issue of existing cover is one that requires specific bespoke advice, because lots of people will have existing cover which perhaps does not fit exactly with the needs that have presented themselves and can change over time. Of course, you always need to consider as well the protection that might be made available from any particular employer through their usual employee benefits. Self-insurance using contingency reserves is also one of the choices faced with many people if they do have some money set aside to provide for themselves to negate the need for any new protection or top-up covers. The one thing that you always need to ask yourself is, are the existing policies fit for purpose when making any recommendation? If they are, then they should be retained. If they're not, then obviously consideration should be given to replacing these. The one thing that's crucial in providing replacement protection is that we ensure that there's no gap in between the two needs. In other words, we would not cancel any existing policies until such time as the new policies are put in force. Finally, we're going to look at state support, and state support is available in certain circumstances, of course, to protect you against the loss of a job, the loss of an income through incapacity, the serious illness elements as well, and also even things on benefits on bereavement. There is a certain stigma that is attached to state benefits though, and some people can't get past this and will not actually look to actually provide or allow the state to provide for them in these situations. This is something that always needs to be discussed with the client. Does the client wish to, or are they prepared to, depend on state support as and when it might become available in the future? Of course, other people, it's not a consideration, they'll take what they can get. So the entitlement to state support should always be considered, and also we need to impact on things like NIC records and the whole premise of means testing, i.e. have you got too much income or too much capital to actually take benefits when building a solution for the client. One of the more vanilla flavour elements of this particular chapter is that of life cycles, which is somewhat idealistic in its approach, but notwithstanding that is something that you may find comes up in your exams. So we certainly need to consider the broader life cycle. And the guide breaks this down into three distinct periods of life. We have our vulnerable years, which essentially is in our 20s and 30s perhaps, when we build families, when we actually have relatively low income and relatively high expenses. The relaxed years, which the book talks about as being in our 40s, where perhaps the children have grown up, become independent, and perhaps the mortgage is paid off. And again, this is where the more idealistic approach takes hold, really. And we actually feel more comfortable with our general finances. And then we've got the anxious years, when all of a sudden we get into our 50s and later life, when we're worried about, have we got enough? Will we leave enough for the family? What happens if I get sick? What happens if I need long-term care, etc.? So the vulnerable years, generally speaking, our formative years of building families and building assets. Low income is a prohibitor. The relaxed years, where perhaps a lot of those situations have resolved themselves and perhaps we're now on a decent income. And the anxious years, when we turn our attention to that ache and pain that we constantly feel, or alternatively worried about the income for the longer term. So the need for protection is often met through life assurance products, which broadly fall into two categories. We have term assurance policies, pay-as-you-go cover in many respects, and we have whole-of-life policies, which involve an element of investments. So both of these can protect against death and or critical illness. Both are designed to pay out a lump sum during the contract life if a certain event occurs, and that certain event is likely to be either the death of the life assured or a serious illness for the life assured. So as we kind of touched on there, really, a term assurance plan is essentially a pay-as-you-go plan. It's got no investment element, normally set up over a specific period of time, and when the period of time expires, then the insurance stops. So you're only going to get a payout if the event occurs while you're insured. A whole of life plan is even longer term than that, and this has an investment element and is designed to run in perpetuity. The idea being with a whole of life plan, as the name would suggest, is it won't expire. Instead, you have the surety of knowing that you will be paid a lump sum in the event of your death, whilst still maintaining the premiums or while maintaining enough money in the pot. So provided that you meet your obligations of premiums, provided that certain life circumstances are met, you have a guarantee here that you're going to get a payout. And often whole of life plans are taken for things like funeral plans and more commonly for IHT plans, as we shall see. So we're going to look at the different types of term assurance plan over the next few slides, and then we'll turn our attention to the various different types of whole of life. So let's start our journey by looking at term assurance policies. And there's a lot of options here, notwithstanding the fact of the number of different providers. There's lots of different types of policy out there. And we're going to get to know about decreasing term assurances, what they are, and what they're generally used for. Increasing term assurances, likewise. Level term assurance, family income benefits, and then probably the ones that are less common, the convertible term assurance and renewable term assurance. So over the course of the next few slides, we'll build graphics that illustrate this, and we'll explain to you all the pros and cons of these. So let's start by looking at the first three main types of protection products that we need to worry about. And these are all the term assurance policies. So what we're going to look at is we're going to look at essentially level term policies, which will maintain a level sum assured throughout. We're going to look at decreasing term cover, which essentially is where the sum assured will reduce over a period of time. And we're going to look at increasing term cover, where the sum assured will increase over a set term of a product. So essentially, we've got the same product, but the sum assured is either going to stay the same, it's going to come down, or it's going to go up. So let's have a look at what actually these are generally used for, starting with the level term assurance in the top left-hand corner. So a level term assurance, which provides a set amount of cover over a set term, are typically used for things like interest-only mortgages, where the amount of the debt will not reduce over a period of time. This guarantees essentially that should death or critical illness, if that benefit's added to the policy, occur within the term, then you'll get paid out an amount which will be guaranteed and set at the same level throughout the term of the plan. These are sometimes used for family protection as well, where perhaps a family income benefit is not available. Decreasing term assurances with a reducing amount of cover over a period of time will typically be used for capital and interest repayment mortgages, where the amount of the debt will reduce over the period of time. Rather than the somewhat straight downward line we can see on the graphic here, more commonly there's an arched reduction in the benefits, as the actual benefits essentially do not reduce on a flat line all the way through the policy to actually mirror that of the mortgage. It often takes a while for actual repayments of a mortgage to have an effect, and that will be reflected in the term assurance. The amount of the actual premium that you pay on a decrease in term assurance will actually be decided and more commonly will be set over the whole process and the whole period of time. In other words, although you will see the sum assured reduce, you generally won't see the actual premiums reduce. Whilst cheaper than a level term assurance, a decrease in term assurance will factor all of that in at the start, and typically speaking you will see a level amount of premiums throughout. The increase in term assurance are probably less common than the other two, if the truth be known. Converse to the decrease in term assurance, here the amount of cover over the term is going to increase. The amount it increases by will be set within the actual policy rules, so it could be that it increases by a set amount each year, or alternatively increases in line with inflation. Whilst there will not be a need to reassess the plan every year, you will see the premiums increase in line with the actual increase in the sum assured throughout. In other words, if you add in an inflation proofing, then the sum assured will go up in line with, say, consumer prices index. You will also see your premiums increase by consumer prices index. So all of these pay-as-you-go set term products, probably the three most popular of the lot shown on the screen in front of us. The next policy we're going to look at is probably the default policy that you would take out to protect your family whilst they are dependent upon you. A family income benefit, as it's known. The idea with a family income benefit is that it will provide a regular benefit each year, an income, as the name would suggest, for the remainder of the term should death occur. Such a policy will be arranged until the independence age of the child, and the amount of cover will be dependent on a multiple of the number of years of income that would need to be replaced to maintain a certain standard of living. So in this example here, we have £100,000 of cover that's been taken out over 10 years. That £100,000 sum assured is essentially going to reduce over a period of time. How it will reduce will be on a stepped basis. In other words, there will be £100,000 of cover at the start. If death occurs after 2 years, it will pay £10,000 for 8 years, £80,000 in total. If death occurred after 5 years, it would pay the £10,000 a year for the next 5 years. And if death occurred after 8 years, it would pay £10,000 per annum for the next 2 years. So all of this is set essentially to only provide the income need, in this case £10,000 per year, over the set period of time. These policies are the cheapest decrease in term assurance policies you can take out. They're the cheapest solution that generally you'll have to provide for family protection, and these are the default option that most people would consider when looking at providing protection for young dependencies. So now we're going to turn our attention to the two more bespoke, I would say, arrangements within the term assurance family. We have the renewable term assurance and we have the convertible term assurance. And the idea with these are that essentially you have an option attached to your term assurance to either extend it on a renewable term assurance or change it on a convertible term assurance to a whole of life. So looking at the renewable term assurance, originally you'll set the actual plan up for a set period of time. The amount of cover essentially will be agreed as part of the contract, and at the end of expiry of that particular contract term, you have the ability to extend that to renew your term assurance without the need to go through any new medical underwriting. So it's almost a guaranteed insurability option that contains within the renewable term assurance. Now these plans tend to be short term by nature. A renewable term assurance might be an annual plan or potentially up to 5-yearly plan where you'll be able to extend it on each particular end of the actual term that goes on. These sorts of policies are popular with commercial term assurance policies. In other words, things like key persons insurance, which need to be short-term by nature in order for you to secure tax relief. So we're going to look at some of those a bit more detail a bit later on. But for now, what we need to really understand is renewable term assurance without the need for fresh underwriting. We can extend the cover, renew it for another period of time. Your policy premiums will go up to reflect the fact that you are older, but there is no fresh need for medical assessment. With a convertible term assurance, as we've already alluded to, at the end of a set period of time, you have the ability essentially to link this onto a whole of life policy or perhaps an endowment policy of some description. This is almost like a whole of life light, with you being able to have a term assurance in early life and then seeing that converted in later life as your needs may change. You will see a significant increase in the actual premiums when you convert it to a whole life, but typically again it will not need fresh underwriting. These two policies are a bit niche and are less likely to appear in your exam or that you will see in real life. So turning our attention now to whole of life policies, and these are much rarer in the protection arena than what you'll expect with term assurance. Here we have essentially protection products with investment content, designed so that the investment element reduces the financial burden as the cost of life cover increases as we age. So essentially what happens is that we build a reserve up by putting more in younger life for what will be needed for later life. That money, the extra money that we've put in, is essentially going to be invested. And the different investment vehicles that you might see generally fall into two categories: the somewhat retro with profit arrangement and the more popular nowadays unit-linked variances. Often whole of life policies, as we've already stated, are used to pay inheritance tax bills or to provide for funeral bills, and often because we don't know when we're going to die and we don't know when this money is going to be required, they essentially fit the bill much more relevant than what a term assurance plan would be. You're only going to need to know the basics for this particular exam. So let's have a look at the whole of life with profits arrangements first. And generally speaking, the way that these work are that you have a set sum assured, which essentially is guaranteed to be paid out in the circumstances of you keeping your premiums going as per the arrangement of the plan, and that sum assured will be paid for when death occurs in the whole of your life. Built on top of that, essentially, you'll get bonuses, which is dependent on the actual performance of the investments throughout. So building off a set sum assured, you have these reversionary annual bonuses, which can be added dependent on the actual fund performance. On death, you can also get what's known as a terminal bonus added, which essentially is a share of any undistributed bonuses from growth that's been made in the policy whilst you've actually had it. So the whole idea with these, generally speaking, were that it gives you that surety of knowing that you've got a set sum assured if death occurs, and also you've got the bonuses building on top. These were very, very popular and linked with styles with endowments and endowment mortgages, albeit those were over a set term in a previous era when we generally took interest-only mortgages out. Unit-linked whole-of-life plans essentially also provide you with a sum assured, and that sum assured will obviously pay out a lump sum should death occur, particularly in the early years of the plan. The idea being is that you actually put money into an investment product, and that investment product is essentially invested as per your attitude to risk, with the idea being that actually over a period of time the investment will actually possibly extend beyond that sum assured, which will give you an amount to be paid on death over and above the expected set amount that was agreed at the start. Life cover is paid, as with the with profits arrangements, by a cancellation of the actual cover on a monthly basis. So if you were to put £100 a month in, let's say, and the cost of the insurance is £5, £100 will be allocated to your fund, and then £5 worth of those units will be cancelled to pay for your life cover. So over a period of your life, each month the cancellation of units will become more and more expensive, but you would have built up a reserve to counter this, so that when the cost of cover goes above your £100 a month you're paying in, you then start to use your reserves to supplement the cover that you've got. So in this situation, essentially the greater amount of the sum assured or the investment performance will be paid out when your death occurs. We're now going to turn our attention away from perhaps life cover arrangements and critical illness arrangements to concentrate on the sickness and accident cover that is available and the different policy protections that are in the market. And we're going to look essentially, albeit briefly, at two main types of incapacity protection. So insurance is available to cover incapacity to work, which is designed to replace your income while you're off work sick or in recovery. And these can be arranged on a short-term temporary basis, known as an accident and sickness plan, or as a long-term plan, which essentially is known as an income protection plan. Generally, these are on a term assurance basis. In other words, they are pay-as-you-go plans. And there is one or two significant differences between the short-term AS plan and the long-term IPP plan, as we will explore in the next slide. I think it's fair to say that there are more income protection plans in the marketplace than there are accident and sickness plans, and mostly the recommendation to meet needs of incapacity would be met by an IPP better than what an AS plan would achieve. The idea with essentially the IPP plan is it's a permanent insurance policy. In other words, once it goes in force, then your insurer cannot cancel that plan. Irrespective of how ill you become, how long you're off work, until the actual expiry of your policy, you are insured while ever you meet the policy premiums. So these are long-term arrangements. There will be a lag before the policy starts to pay out. This is known as a deferred period. This should be set up to meet your needs. In other words, if you get paid by your employer for 6 months if you're off work sick, you'd want a 6-month deferment period in an IPP. Taking a deferment period less than 6 months, it would not be financially prudent, because you are not allowed legally to benefit from the insurance above that of the actual amount you receive in wages. In other words, if you were still being paid, even though you're insured, the insurance would not pay out. These will be underwritten before the policy starts, with significant medical questions being asked, and even things like your lifestyle, your hobbies, and anything that might compromise your ability to work through increased risk of accident and illness essentially being taken into account. The income protection policy is earnings linked, as we've just mentioned. It must be linked in specifically to your wages, and also the amount of policy premiums is going to be driven by what you do for a living. It's going to be more expensive if you work on maintaining the highways than it is if you work in an office. Policies can only be arranged on a single life basis on an income protection plan. So in summary, a long-term policy linked to your wages, linked to your terms of employment, underwritten at the start, but permanent in nature. While you pay your premiums, you are insured once the policy goes in force. Accident and sickness plans could be seen as income protection plans light. These are generally annual policies, renewable each year, therefore short-term by nature. They often don't have a deferment period linked back to your employment. They can kick in after 7, 14 or 30 days. There's no underwriting taken at all, but the policy actually can be declined at source. It's not earnings related nor occupational linked. Single and joint plans can also be available. So typically an accident and sickness plan will agree to pay you for a set period of time, i.e. 12 months, in the event that you're off work for an accident or a sickness. At the end of that policy term, you will not get any more benefits from it, and obviously there's a strong likelihood that your insurer will refuse to insure you again the next year. Often confused with income protection plans, which are designed to pay a monthly amount to replace wages, are critical illness plans, which we've kind of already touched upon when we looked at life cover, because lots of people who take critical illness cover out do so by tagging it on to a term assurance plan or potentially even a whole of life. Critical illness cover, though, can be bought on its own as a standalone policy. The idea being that it will pay a lump sum out to you if you're diagnosed with a listed critical illness. So often you can have it as a joint life first event basis, which includes life cover, but you can also have it on its own. The downside with these plans is that they are actually there's a need for them to be survived from the diagnosis. So in other words, if you were to unfortunately drop dead of a heart attack in the street without you being diagnosed with a heart problem, then that's not going to be covered. It actually needs to be for those people that suffer essentially the critical illness. Most serious diseases are covered, as you can probably imagine, and we'll take a look at the ones that typically will be in every single policy on the next slide. So a critical illness policy is likely to cover certain cancers, certain invasive cancers anyway, heart attacks, strokes, total permanent disability, and also the failure of major organs. These tend to be in every single critical illness policy. And then you find that certain other policies will have additional ailments and illnesses that they will consider also to be critical illnesses. Things like dementia, HIV, etc. can be added onto certain policies. So just remember what we're saying here. These pay a lump sum if you are diagnosed with one of these illnesses, and will often have a survival period built in. In other words, you've got to survive 14 or 30 days before the policy pays out. This is where essentially the beauty of having life and critical illness cover comes to the fore. For if you actually are diagnosed with one of these illnesses and fail to survive the survival period, if you've got life cover as well, the life cover will pay out even though the critical illness cover wouldn't have done. So now we're going to turn our attention to some of the other insurances that are out there, and we're going to start with private medical insurance, which essentially is the ability to jump NHS wait lists and get access to private treatment in private hospitals. Generally covering chronic conditions, i.e. those that will need a series of treatment, these can be arranged on either a moratorium or full underwriting basis. So the idea with private medical insurance is You choose a level of cover, and typically there's budget, standard and comprehensive covers available, and that these will actually give you access to Bupa and to certain other private hospitals around the UK. Arranging a policy on a moratorium basis essentially is where you declare its pre-existing conditions and they will be excluded for the initial period of the policy. On a full underwriting basis, you'll have to go through full medical assessment where, generally speaking, you will know exactly what the insurance company are prepared to insure for you before you start the actual plan. Private medical insurance is commonly provided by employers for their employees, albeit a benefit in kind for those people that are lucky enough to have it provided for them. So, turning our attention to long-term care insurance now, certainly a rising insurance need as we face the population increase that we've had and the ageing population that we have in the UK. Obviously designed to provide for care in later life, and we need to consider the activities of daily living when considering long-term care, because any type of insurance that's taken out is likely to be dependent on a payout on your ability to undertake certain activities of daily living. Now, without going through all of these in great detail, an example of this would be things like washing yourself, dressing yourself, being able to go to the toilet yourself, being mobile enough to go shopping for yourself, transferring to bed in the evening, etc. And insurance policies can be taken out that would pay out on certain activities of daily living no longer being capable of being performed. So long-term care insurance, whilst not many specific plans are around in the market, it's a growing market, and we're going to look at immediate needs and pre-funded plans. Now we're going to turn our attention to long-term care, and over the course of the next couple of slides we'll get to understand this somewhat niche environment of long-term care. Long-term care is something that's increasingly becoming a concern to many people in an ageing population like we have in the UK. And people can prepare for their care in longer life, or alternatively there can be people where long-term care is somewhat forced upon them with a certain shock event. So a pre-funded long-term care is, generally speaking, where you would save up for your care in later life, generally involving some form of life assurance plan. If you're unable to complete certain activities of daily living, which is the usuals, washings, dressings, shoppings, transferring to bed yourself, toileting, etc., then essentially the insurance policy can pay out. There are not many pre-funded specific long-term care policies on the market nowadays. Immediate need, sadly, is what most people experience when something happens, i.e. a stroke, when actually the need for care is immediate and not pre-planned. In this situation, it can involve the use of an individual's own assets and involve using that money to buy annuities, incomes for life, which essentially could be tax-free if paid direct to the care home. Again, the younger you are, essentially the longer the care requirement's likely to be, the higher the cost it's likely to be in this situation.